Welcome to Einstein's disease. Through real-world insights and powerful conversations with industry leaders, we help you break past limitations and rethink success. Are you ready to push the boundaries of what's possible?
Hello, my name is Greg Ehrs, and I'm the host of Einstein's Disease, where we explore challenges and overconfidence and stagnant thinking in the professional and personal life. Our mission is to give the individuals that are watching our show tonight the ability to understand a new problem and some solutions that come with that problem to potentially get you over a hurdle that you are experiencing in your personal life or at work in your professional life. Today's challenge that we're going to be talking about today is consumer financial distress. Many of you listeners and viewers were fortunate to receive interest rates on your mortgage somewhere between 2 and 3%. But over the course of the last few years, we've experienced higher levels of inflation, cost of living has gone up, and the traditional method of being able to extract wealth from a home to be able to pay for your exceedingly higher expenses has gone by the wayside due to the fact that many people don't qualify for those. My guest today is I'm the host, Steve. My guest today is Steve Hotovec. Steve is our relationship goes back many, many years. Steve is a pioneer in an area called home equity sharing agreements, where people are able to extract wealth from their home. And we're going to talk about that today in the second block as a solution. But first, I'd like to introduce Steve. Steve, welcome to the show.
Thanks, Greg. Glad to be here.
It's good to see you, Steve. It's been a while. As I laid out in the beginning, consumers and businesses, for that matter, have seen the cost of their capital go up materially over the last few years. And maybe it's abated a bit over the last medium term here, 2 to 3 months. But overall, the cost of capital is significantly higher, putting a real challenge to the consumer and to business owners. And I want you to kind of share with the audience a little bit of how you see this as a big challenge relative to past history, specifically with respect to being able to roll down the curve, if you will, and be able to cash out refi for a mortgage or for a business.
Sure. Well, as you mentioned, it's been, I would say it's been about a 40-year run where we've been able every year. Homeowners have been able to always kind of tap into that trapped equity, right? For 40 years, because interest rates really haven't moved. Okay, so that's a historical, event economically. So if you look at the household, the majority of households have the majority of their net worth, homeowners, trapped in equity. It's the largest asset class in the world. The good news is the two biggest assets that most households have is that, as you mentioned, that low first mortgage, okay, and then a stockpile, an unprecedented level of home equity. The problem of the last 2 years has been, as interest rates have gone up, okay, accessing that through traditional means, which is either taking out a cash out refi or a HELOC, a home equity line of credit, that's been kind of shut down. Because the homeowner basically can't get access to it without refining that first. So what really has happened, you have a scenario where more than ever, homeowners are what we call house rich but cash poor.
Right.
It's put a big strain.
Maybe touch on a little bit with respect to what you see with the consumer, because they were fortunate during the pandemic to be able to lock in a low interest rate, Steve. But subsequent to that, we've seen higher levels of inflation. And do you see people that the statistics would show that credit card debt is at an all-time high. So people are paying much higher rates, but yet at the same time, have their credit scores been affected by this, Steve? Is that part of the challenge that some of these consumers are seeing?
Absolutely. And as you know, and most people know, but just as a refresher, there's something that's called utilization. So the utilization percentages have gone up significantly. And as utilization If you have 10%, 20%, 30%, these high utilization rates actually adversely impact your credit score. So where
And
you
you
might have
just
yeah,
for our listeners on that utilization, is that where I may have a credit line of 1,000 or $5,000 and I use that and carry a balance? Is that how the utilization is determined, Steve?
that's exactly right. If you had a $5,000 say credit available and you use 2,500 of it, you would have a 50% utilization, which is very high, which actually would push your credit score down. And you're seeing utilization rates now much higher than they've been in the past years.
Got it. And when we talk about credit scores and being able to access a home equity line of credit or a cash out refi, um, there's specific credit scores that are required for those, Steve?
Sure. And I'm not an expert on, mortgages and credit lines so much as I am on the equity side, but you really need to have at least 680, and it's usually more in the 700s to access, home equity lines of credit. So at the same time that uh, house wealth has grown, credit lending standards by banks have actually gone up. Okay, so it's actually tightened, so exacerbating the issue.
And they've tightened subsequent to the increase in interest rates. Have you seen that tightening of credit
Correct.
standards gone up the last 2 to 3 years?
Yes, everything. So interest rates went up, and the availability of credit got tighter by banks and lending. That's exactly what's happened.
Wow. So what the kind of mosaic you're laying here is that everybody, many people may have been first-time home buyers or moved up into a home during those that low interest rate cycle, which was a generational low, I think, right? That when you were getting a three
Yes,
percent, we haven't seen that since the '60s. It's been
right.
quite a while. So what you're saying is they were able to get themselves into a situation, but be it property taxes or other costs, those homes have gotten expensive, and now they've run up their utilization rate on their credit cards, and they're kind of in a quandary. Is that a fair way to say it, Steve?
Yeah, you literally went from tailwinds from the homeowner, as you're describing, between low interest rates and the ability, the ease of borrowing, to full blown headwinds, right? And then you look at even insurance costs, right? In the state of California, and in a lot of states. So the cost of money has gone up, but the cost of even taking care of that property, anywhere from insurance, to debt coverage, has gone up significantly.
No, I hear you.
Mhm.
So when you talk or when your team speaks with people that are in this situation, what type of I mean, they obviously have a problem. So you're conversing or your team's conversing with these people. What is there a are they educated on their credit score and their utilization? Are they educated on the absolute expense? I mean, where is a home equity line of credit relative to a mortgage? Is it considerably higher? I mean, are they talk to us a little bit about the level of education that these people that you speak to every day or your team speaks with to every day?
Yeah, generally speaking, they're not quite as educated as you would think, but they're getting educated. The harsh reality is they're actually looking to pay off credit card debt, so they're going to their bank or a lender, and they're looking at it, maybe a cash out refi. That's usually the first stop, and then when they find out that they would actually have to renew their first, the mortgage, and to get additional capital, that's not attractive, right? Who wants to go from a 3% to a 5, 6, or 7%? Then the next step that they'll go through is a HELOC, or home equity line of credit. And then they'll find out that things such as credit score and a ratio that's called DTI, which is debt to income, that those ratios need to be lower than what most households are carrying right now. And it basically, it's just an extrapolation of, say, credit. We talked about credit utilization
Hmm.
at a larger level. At the household, you look at all of your debts, meaning how much do you have your car payment, how much do you have on maybe loans, maybe house loans, etc., how much you have a disposable income, and demonstrating your ability to repay. So these conversations happen every day. with homeowners that are finding themselves either unable or unwilling, quite frankly, to take on the burden of additional debt. Right.
No, for sure. One last thing I want to touch on. I don't want to spend a lot of time on it before we end this block, but what's your to our viewers out there that find themselves in this difficult burden and maybe looking at credit consolidation, where they stop paying their credit cards, they stop paying their high interest, and their credit score falls materially. Do you have what's your opinion on that, Steve? I mean, how does that square with what's going on? Are you seeing more of that? Is that a good way to go? What do you think?
Yeah, well, it's not a good way to go, but I think a lot of folks don't understand the long-term impacts of, kind of destroying or wrecking, if you will, your credit, and they don't really know where to turn. I think there's a lot of there are other options out there, such as the products that we use, but the word's not really out on them. But I would always stress to homeowners not to let your credit get in that position, right? And I think with most homeowners, it's too little too late. You get that, you run up in the utilization and they cannot keep up with the payments.
Absolutely. And we're going to be back in a few minutes with Steve to move on to some of the solutions, and specifically a solution that Steve and his company offers. And with that, we'll cut away to a commercial. Thank you very much, Steve. We'll see you in a minute.
Thanks, Greg.
You break past limitations and rethink success. Are you ready to push the boundaries of what's possible?